Hello, folks. Welcome to Pro Trader Strategies Market Commentary. We are an educational company, and what we're trying to do here is to show you how one could implement options into a portfolio at any given time. So if you're new to this, please smash that subscribe button right down there at the bottom so that you can get notifications when we're doing these. We're going to try and do them right around 11:30 Eastern. So, if you can set your alarm for that. Otherwise, get that subscribe button so that you get notification, like button. And hey, finally, if you have any questions, comments, or anything you want to discuss in future webinars, throw it over there in that comment section. I'm going to be happy to go back and forth with you folks down there. If you have any questions, maybe we'll cover it in the next video. So please comment down there. I'm going to make sure everybody is clear of concept. So in this video, what we're going to do is we're going to talk about the economic data. We're going to see how that's impacting the overall markets. And then ultimately, what we're going to do is talk about option strategies we can implement into a portfolio based on those assumptions we come up with. I've done webinars too, or I do webinars, I should say, where I show you how to streamline your process to find the best strategy for any given assumption. Anyway, without further ado, my name's Eric Wilkinson. Right down there at the bottom, you can see it. And I used to do some stuff on mainstream media where I talk about the economic data, geopolitical environments, all of those things. I'm going to do the same thing for you folks in these daily market commentaries and talk about my option strategies that I implement into my portfolio. All right, with all that done, let's get on with the overall markets. We've got the economic data. Pretty much we're going to kind of filter through it as we go along here. But yesterday, late in the afternoon after I did this video, we got the crude oil inventories number, and it actually came in a little bit hotter than what was expected there. And with that said, we saw the markets actually start to sell off a little bit yesterday, despite the fact that we saw some of those numbers a little bit higher than what was expected. In that, we were expecting a crude oil inventory drawdown of right around, I believe it was right around 3 million barrels. 3.3 million barrels was expected, came out negative 5.2 million barrels. So 2 million barrels over what was expected, a drawdown of 2 million barrels. That means less supply should drive demand higher here a little bit. Well, yesterday, after that data point, we started seeing a little bit of sell-off, seeing a resurgence today, probably based on the fact that CPI numbers are coming in a little bit hotter than expected. Consumer price index, that's what the consumer is feeling. Remember, we watch these numbers going from the PPI, which is the producer, how they are being impacted by inflation. Can they pass that on to the consumer? And we start to see that show up in the consumer price index, which is what we got today, coming in at 0.6% hotter than the expected 0.4%. And then we also got the core CPI, which is basically going to strip out food and energy because those are a little bit more volatile aspects of this data point. That's still coming in hotter than expected at 0.7%, expected to be 0.5%. Now, when we see those transitory things or the transitory talk from the Fed, they're talking about basically food and energy there, folks, where that would fluctuate. All right. Well, we've already seen higher cost for the worker from the company has to pay higher prices. They're passing that off to the consumer. We saw that in Chipotle the other day. So we're starting to see the producer passing on higher costs to the consumer. All right. That's kind of you and I and basically everybody else. What we really want to look for is personal consumption expenditures now, because folks, that's the retail guy. That's you and me and what we are paying every single day. It's not necessarily, say, for instance, a wholesaler that's buying goods from China and then jacking up the prices and being a middleman, if you will. So those prices are starting to move higher. Unemployment claims also creeping higher here at 376,000, expected to be 370,000 claims. All of those things probably making most people, we're going to have to really stretch this out a little bit further to see if this spike in inflation is transitory or not. I've already showed you a couple of examples where it's really not transitory so far. But a new high in crude oil today. Yesterday was looking really toppy, but today breaking that pattern, not really getting any type of confirmation. The bonds the last few days, we actually saw the 10-year note, which is this right here, go below 1.5%, which was the first time we've seen that happen in a couple of weeks or a couple of months, actually. Today, the chart pattern really starting to look a little bit toppy here in the bonds finally, or even in the 10-year. We're going to look at the 10-year here on this particular example, though. So when we go over here, let me get back to the questions, make sure I'm not getting any questions. Thanks, great for the commentary. Appreciate it. All right, so with the notes here, what we're looking for in swing type trades. So if we're looking at a bond start losing a little bit of momentum, we can see that this little pattern here is setting up for a bit of a top right there. So that pattern today has that candlestick, which is a hangman doji at the top of a move where we've seen it lose momentum, or there's some resistance, overhead resistance there in and around this area where we are right now. And that lines up with right around that 1.5% in the 10-year notes. That's kind of a dirty little drawing there. I don't know if that's exactly 1.5%, folks, but you guys get the gist. We're right in and around that. So at the end of the day, interest rates going down because of that whole teeter-totter effect, right? The bonds go up. That's that asset buying that we talk about from the Fed. It's not just the Fed, but when we hear asset buying, the Fed is coming in and supporting these instruments. So that drives prices higher, right? And we've all heard that when prices go higher in these bonds, usually what we're hearing is that the interest rate is going down. And that's exactly what the Fed is trying to do. They're trying to buy these types of assets like the bonds, the 10-year notes, and that brings the price up, and they are inversely correlated, so the interest rates start going down. They're really trying to do that the last couple of years, right, when we started seeing this quantitative easing. So when you hear that, that is the idea behind quantitative easing there. Gold futures moving to the highs of the day at this point. But folks, we're right there at that point of control. I mean, I can't beat a dead horse enough. 1900 is a psychological line in the sand. The real overhead resistance is going to be that 1923, which lines up with our highs from the financial crisis in 2011. So seeing that market try to revisit that is a difficult task right now. It is an inflationary hedge. So if you are expecting inflation to rise, that should drive the price, or then you would see bonds follow it. Now, yesterday we were talking about getting up to that 3,700 area, somewhere between 37,000, 35,000, 37,000 is kind of becoming the sweet spot for Bitcoin. Today we went up there and tested that area, right now hovering above that 3,700 or 37,000 mark. But again, when we're looking at charts, this whole setup right here is looking pretty bearish. All right. Yes, we've got that bounce confirmation off of that low with that hangman doji. Now we've got this spinning top doji at the top of a move, at the top of this move here, which kind of lines up with the point of control. Now that could be a little bit messy, but something that we need to keep an eye on moving forward. If we get a confirmation tomorrow with something like a nice big red candle, then I would expect us to start coming down here and revisiting this 30,000 mark. All right, that's where we're lining up with that 38 Fibonacci. That should be our next support level. 30,000, let's call it 400, is where we should start to see that momentum slow. At the end of the day, though, I'm not in Bitcoin. I haven't added any trades for anything in the cryptocurrencies as of recently. I'm just kind of waiting for most of this stuff to shake out there. I don't want to get involved in something that is that volatile. I like to trade the lagging indicators, folks. I'm not going to ever trade the VIX. That's a leading indicator. I'm not going to probably ever trade the bonds. That's why I trade 30-day Fed funds for years, right? Some might say that's a bit of a leading indicator, but what we normally see out of interest rates is it starts from it used to start from the bonds and then go to the 10-year. Now it's starting at around the 10-year and leaking out in both directions to the bonds and to the shorter duration futures in the financial complex, which is Fed funds is the shortest duration they have. All right, let's get on with the equities. We've got the NASDAQ moving higher today by about 100 points. Tech starting that charge back in, out of that sector rotation where that reopening trade, we were looking at the blue chips really driving higher, seeing a little bit of a lag here from the NASDAQ. Well, that NASDAQ is starting to make that charge now. Tech's starting to really recover here, leading the way to the upside, as you can see with the Dow Jones Industrial Average, although they are up 120 points, just really not quite seeing that strength like we're seeing there in the NASDAQ, actually coming off of the highs here in the Dow Jones Industrial Average. E-mini S&Ps made a new all-time high today here, 42.49. That was printed intraday, so that's something that chartists will really start to look at because the day session printed that. You know, you've heard me talk about it. We do need to take more and more credence in the overnight trade, but when those daytime prints happen, that is a solid marker for us to set charts up on. And with that being done during the day, we'll be able to reset up our charts on that high, especially if we start seeing this little bit of correction here. All right, Dow Jones Industrial Average ETF, DIA, is what I've been playing around with. Now, if you guys remember when we were setting this trade up from the webinars that I'm doing right now, where we're doing it on swing trades, we're finding the swing trade, we're set up, and then we're ultimately digging down on those details and finding the best strategy for that assumption. And with that said, when we were looking at DIA, my thesis on this is we are probably going to start to see a bit of a topping pattern here in DIA and slow down this upward trajectory that we saw all of 2020. So watching these daily market commentaries, you folks know that I'm thinking the market is going to be in a relatively tight range for 2021. Now, we've already stuck in that range pretty tightly so far. I think we're going to continue to see that same consolidation throughout the rest of 2021. 2022, everything's up in the air because that's when the Fed's going to start playing around. All right. But right now, they're not playing. Momentum probably to the upside. Well, that said, doing a calendar or a diagonal in a situation like this is really good for an underlying when we're looking for that type of move. So with this said, I went into the September and I bought the 355 calls in there. All right. Longer duration, limit that theta decay. I also wanted to try and pay down some of those extrinsic costs that really can hurt a person buying an option. So I covered that by selling the 355 calls in the June. All right. So the June is the shorter duration, paying off that extrinsic value of those longer duration options. Now, I did this entire strategy at one time, but I'm trying to leg out of it right now. I'm trying to get out of my June short 355 calls that I originally had collected $1.46 for around a dime. So I'm about 2.5 cents away from that. That's why I want to mention it. It's not out of the woods yet. I haven't covered that trade. 8 days to go. But I want to, anytime it gets down there at around 10 cents or a nickel, that's what I'm looking to cover that trade for. Just to get it off. There's no reason to keep that on for another 10 cents. I've taken most of the value out of those 355 short calls. That way I can take that off. I increase my break even to the upside. I can take advantage of it all the way after I take off those short 355 calls. All right. And then I didn't want to go to the bonds. I actually wanted to talk about my other trade that I wanted to look at here. So let's take a look at EWZ. I'm doing this based on a swing trade. We've gotten this topping pattern at the top of this move, and I want to take advantage of that. Whoops, I don't want the line, I want the square. I want to highlight this little topping pattern here. So basically, we've gotten this consolidation at the top of this move, right at that Fibonacci that showed resistance. We've fallen away and failed. I am looking for a gap, this gap to be covered here, right in between those. So a correction to come down and cover that gap where we spiked above that. Markets like to revisit those areas, folks. So with that said, I'm looking to play this to the downside. Now, when I'm looking at the downside trade in this, though, what are a couple of the things that I want to look at for that trade? Well, I want to look for this type of pattern at the top of a move where we've gotten this consolidation, confirmation to the downside. Also, we have this little gap, I'll just draw it with a box, that I think is looking to be covered here. That box area should look to be covered, so I'm looking for a correction in this market. Now, I'm looking at volatility down here to determine what type of strategy I want to implement, right? Volatility tells us if our pricing are expensive or cheap in the option montage. Well, I've discerned that the options were expensive, especially this morning when when I entered this trade. You'll be able to see the example today, this afternoon. I'll break this down even further, but I went in because it had high implied volatility. In my trading account, I sold the July 42.5 calls in there for 80 cents. Now, obviously, I think that it's going to hold this 42 top, a 42.50 strike. That puts me above where the 52-week high is there. So feeling pretty safe with that Fibonacci and everything else, confirmation to the downside. Now, over in my IRA, it's not legal to do just a naked short call in there. So we've got to look at a different strategy that we might be able to still take advantage of this high implied volatility and a bearish directional assumption, right? Or if you have a limited margin in your trading account, maybe a smaller portfolio, or you just don't have a ton of money to allocate, but you found this opportunity in the market, you could use a short call spread as well. And we'll break down the details as to when, where, and why we would use a short call versus a short call spread and the strike locations we're going to be looking at for that. I'll talk about like deltas and things that I just don't have the time to cover here today. But with that said, over in my IRA, I went into the July, sold the 42 calls, and then bought the 43 calls to define that risk. I have no risk above 43 at that point. So, and I collected it for 33 cents. Dollar-wide spread, collected 33 cents. I know I have limited risk on that, and we'll break all that stuff down for you today in the webinar. So please go check that stuff out. Finally, one last thing is, if you enjoyed this webinar, subscribe. Finally, smash that like button, all right? And comment if you have any questions, comments, or anything else you want me to talk about. So if you can't smash that, take that. Bye for now. Have a good one.